Hi, I'm Denise Chisholm, Director of Quantitative Market Strategy at Fidelity Investments. And today I'd like to talk about a few important trends we're seeing in the market and what history has to tell us about where the broad market and individual sectors may be heading next. The second quarter began with ongoing geopolitical tensions in the Middle East. By the end of the quarter, however, the U.S. and Iran had reached an agreement. The Straits of Hormuz gradually reopened, and oil prices pulled back from their highs. Even so, energy prices remain elevated, inflation's still a concern, and many investors worry the Federal Reserve will raise interest rates later this year. Against this backdrop, the U.S. economy remains resilient, with improvements in several key leading economic indicators. U.S. manufacturers' orders of core durable goods orders jumped in the first quarter. The metric's year-over-year percent change was recently in the top quintile of its historical range, a level that's correlated with the strongest likelihood of both median earnings growth and job growth. We've also seen strong capital expenditures to sales ratios, signaling potential market gains in the next 12 months. Now, a strong rise in core durable goods orders has increased the likelihood of a Fed hike historically, but stocks rose nearly 80% of the time when the Fed raised rates and core durable goods orders were in the top quartile. The market has been slightly more likely to rise when rates rose than when they fell. Why? Higher rates often reflect strong economic growth, and that tends to be good for the market. Small rate increases have historically been the sweet spot. Turning to sectors, semiconductors stand out. The sector showed strong momentum over the last 2 years, and earnings growth has been even stronger. This has in turn reduced semiconductor stocks' price-to-earnings ratios even as the stocks have risen. Now, at the end of the first quarter, the sector's relative valuation fell to the bottom quartile of its history. From similar starting points, semiconductor stocks outpaced the market over the next 12 months more than 3/4 of the time. Energy, however, doesn't look so good. The average energy stock's forward PE ratio recently eclipsed the broad market. Some investors would argue that oil prices are likely to stay high and help justify these lofty valuations. But history suggests a bit of caution. Since 1990, a period that roughly corresponds with the modern energy era, energy stocks have underperformed when oil prices rose and when valuations were at or above the markets. For more information about our views on current market trends and sector investing, please read our complete quarterly sector and investment research update at fidelity.com/QSIRU. Thank you.